Assets. My name is Bailey Eddings. I'm a sophomore. I'm from Kansas City, and my major is sport management.
I'm Jackson Dietz. I'm a junior. I'm from Olathe, Kansas, and my major is creative writing.
I'm Alexis Summer. I'm a junior. My major is sport management. I'm from Sacramento, and I'll be filming this.
I'm Kyandra. I'm a junior. I'm from Shawnee, and I'm majoring in health information management.
My name is Dana Shobaki. I'm from California. I'm a junior. My major is journalism. Our company is Target. It's been around for 53 years. It originated in Minneapolis, Minnesota. There are stores all across America, approximately 1,800. Their slogan is expect more, pay less. Target is a retail store that sells clothes, toys, household supplies, decorations, and groceries.
Target's total current assets are $22.21 billion. Target hasn't identified any accounts receivable that it believes to be uncollectible. This makes sense because it's a retail store, so whenever a customer wants to purchase something, they go and they pay for it right then. So there's no chance to accumulate uncollectible debt. The intangible assets of Target are non-current assets of discontinued operations, and that's the only one that's really identified in their notes, and that totals $442 million. Target uses the straight line method to determine this, and it states that in the footnotes.
For current liabilities, Target has $11,736 million. A few of the liabilities that we found were accounts payable, which is paying employees for their wages monthly. Another one would be liabilities of discontinuing operations, which would be stop selling products and maybe stopping certain training requirements. Accounts payable for 2014 and 2013 for Target is around the same, so really it means that they haven't made any major changes in their employment and payrolls. They haven't hired more employees than they had or fired more than what they had before. In 2014, the discontinuing for operations was much higher than 2015, so comparing that to 2015, they didn't cut as many operations, whereas 2014, you can see Target as cutting a substantial amount of their operations out of their liabilities. Long-term debt for Target is listed as long-term debt and other borrowings. Their amount for that is $12,706 million. Going on to stockholders' equity, the total for that would be $13,997 million. When looking at the retained earnings for Target, we have $9,644 million, and the retained earnings represents the dollar amount for which the company can invest back into their business operations. For Target's income statement, first off, we'll consider gross profit. To calculate gross profit, you'll take sales minus cost of goods sold. And for 2014, that'd be 72,618 minus 51,278, which results in $21,340,000. In 2013, you'd take 71,279 minus 50,039, and that equal 21,240,000. So comparing the 2 years, they're almost identical gross profits. That shows that the company is running at a steady pace and they're very stable. Now, considering gross profit ratio, we have to take our gross profit from before, and we'll divide that by the total sales of the year. So for 2014, we have 21,340 divided by 72,618, and that comes out to 29%. And then considering 2013, we have 21,240 over 71,279, and that equals a little more than 29%, and 2013 is hanging at 30%. So there's a bit of drop in the ratio by 1% when comparing 2013 to 2014.
Another part of the income statement is earnings per share. In 2014, there was a loss of $2.58 per share, and in 2013, there was a gain of $3.10 per share. As you can see, it has decreased slightly and shows that Target might not be able to operate at a profitable rate. Thus, they might not be earning as much money from the stockholders as in 2013. The current stock price is $72.81 per share, so the ratio is $28.22. And this tells us that if the stock is expensive, society perceives Target as a company to invest in because it is a low-risk investment.
Had no gain or loss. Their receivables had $0, and they didn't gain or lose any revenue. Their proceeds, disposable and property and equipment, had a gain of $95 million from selling. Target implemented the straight line method to identify their intangible assets to amortize lease, hold, and acquisition costs. They also identified advertising costs such as newspapers, internet ads, and media broadcasts. And we found that from the notes to financial statements, we found that out of their total property and equipment of $124 million of equipment was impaired, and their life expectancy for computers is 2 to 7 years. In another note, their goodwill had more amortization projected to gradually decrease from 2015 to 2021, which is good because they will be decreasing their liabilities.
Okay, as a group, we decided that we will invest our money into Target. Our first reason being that it has a lot of current assets, $22 billion roughly, and they have hardly no accounts receivable that's uncollectible. So this is very good and proves that Target is operating at a very effective rate.
Another reason we thought Target would be a good investment is because on their 10K, the goodwill table is projected to decrease over a 4-year span from 2015 to 2019, which eliminates liabilities, making it a better future prospect to gain from.
We also decided to invest in Target because even though the liabilities are high, the gross profit and income are also high. So this balances it out, and therefore that is also why we should invest.
Also, their stock price is also high, which means that society views highly of Target.